Welcome back to another episode of Palisade Radio. This is your host, Colin Cattell. New guest on the program today. I just got to see him in New York at the Mines and Money show. His name's Jordan Trimble, and he's the CEO of Skyharbour Resources, which is SYH on the Venture Exchange. Jordan, welcome to the program.
Thanks for having me, Colin.
I'm really excited to get you on. I'm surprised I haven't had you on yet. We try to get a lot of the younger crowd, the new guard in mining on the show. My friend Matt Geiger's come on quite a few times. I know you know him. And you're only 29 years old at this point. I think you may have been the youngest, or definitely one of the youngest CEOs of a venture-listed company a couple of years ago at least. And I want to start by asking you a little bit about your background, how somebody at your age gets involved and becomes a CEO of a public company.
Yeah, absolutely. Well, I guess I'll start then with my initial few years in this industry. I have been working in the industry now for just under a decade. I basically came right out of university, having studied a joint degree in business and science in 2009, 2010. Jim was running a company called Bayfield Ventures, which was a gold exploration company with projects in the Rainy River district of Ontario. It's kind of tucked right in the southwest corner, if you will, by Manitoba, Minnesota, and in Ontario. And I came in at a time when the market after or post 2008 was recovering. In particular, the commodity space was really looking good. We were in a bull market, and what we did at Bayfield was really kind of eye-opening to me as a young guy in the industry. We went out there, acquired projects, gold projects in this district in a good jurisdiction. And over the next few years, we had a lot of exploration success. We went in there, we raised some money, went in there, and we drilled a project called the Burns Block, which was right beside a growing gold-silver deposit called the Rainy River. We basically had almost like an extension of the deposit. It was shear hosted, some very nice high-grade gold and silver mineralization, and we went out and we proved up a small resource. And ultimately what happened there was a acquisition. New Gold came in, which is a mid-tier gold mining company dual listed here in Canada and the US. They acquired Rainy River, and then subsequent to the Rainy River acquisition, they acquired Bayfield. And I was involved with that, Jim running the company. And it was it was a great kind of case for me to look at and say, okay, this is this is how you do it, and we go out there, we raise capital, we try to work with the best technical teams that we can, that know how to go out and find these deposits, delineate a resource, de-risk the projects as much as they can, and really create an asset, build an asset, prove up an asset that a larger company is going to want to acquire and going to want to buy. And so we did that with Bayfield. I for the first few years, I was doing corporate development for Bayfield full time. Yeah, so I did a little bit of work with a few other companies in various different metals and commodities. And really my interest lies in the earlier stage part of the mining cycle and in mining companies. I really do enjoy working with exploration teams, geological teams, going out there and looking for these new deposits, right? As we know, and it is a bit of a cliche, but as we know, big mining companies on a daily basis burn through their asset base, right? I mean, that's by their very nature, that's what they do. They're mining their reserve base, their resource base, and they need to ultimately replenish that. That's what always kind of drew me to the exploration side, is knowing that, ultimately the big companies, we're going to have to look at the smaller companies that go out and find these new deposits, find these new resources and reserves, and ultimately look to acquire them to replenish what they mine on a daily basis. So I came in again with more of a capital markets and finance background. During my time at Bayfield and working with a few other companies, I completed my CFA, earned my charter, and actually I sit on the board of the local society here in Vancouver. So I do come from more of a call it a mining finance background on the issuer side. And then in about 2013, early 2014, well, it was really 2013 actually, early 2013 when it started. I was looking at various projects for it was just a shell company at the time, Skyharbour Resources. We were looking, Jim and I, to find projects in good jurisdictions that we felt we could add value to, go out there, had strong exploration upside potential, and much like with Bayfield, go in, acquire the projects, work the projects, explore the projects with a good geological and technical team, and ultimately, hopefully one day, look to be acquired by a larger company. So that was really the genesis, if you will, for Skyharbour as we know it now, and for me getting involved with the company. And I came in and basically helped structure the initial deals that we did. It started actually with what we called the Western Athabasca Syndicate, so basically a partnership between 4 companies on a big property package out by Fission and NextGen in the Athabasca Basin of northern Saskatchewan, the highest grade uranium depository in the world. And it's subsequently evolved from that. We've been very active, as you know, acquiring projects over the last 4 years at attractive valuations, building an asset base, assembling a team that has focused expertise on uranium exploration, high-grade uranium exploration in the Athabasca Basin. So that's a kind of a quick history of me in the industry. And I'm young, I'm passionate about it, but I work with an excellent team. I have some very experienced and reputable people around me. That's something that I've really tried to focus on is, team up with both other people as well as technical and geological people. My head geologist, Rick Kazmersky, or Radioactive Rick, as he's known as in the industry. He's based in Saskatoon. Him and I and Jim Pettit really were the kind of the founders, if you will, of Skyharbour about 4 years ago, and we continue to run it to this day.
Jordan, your background came more so in the gold and silver space. I want to understand what the opportunity was that you saw in uranium and why you segued away from gold and silver. I think you're probably still active investing in those spaces to a small degree, but what were the drivers that pushed you over to the uranium side?
Yeah, no, so I really was kind of commodity agnostic, to be perfectly honest with you, in 2012, 2013, and my background really was working with gold and silver companies, precious metals companies, and even there was a base metal company. So I was I'm familiar with all the metals, and I was looking really, Colin, at the time with Jim at a deep value contrarian opportunity. I mean, we hear that term used a lot in this industry, and some notable individuals like a Rick Rule, Marin Katuza, who's one of our largest shareholders. They emphasize this point of being a contrarian, and I think it's a very important point. I mean, when you go and really, I really have a passion in building companies. That's what I want to do, and so. I saw an opportunity with Jim and our team here to go out and build a company, in a uranium company, in a market that had been basically decimated by a black swan event, which was Fukushima. Actually, as I tell people, it was really a number of black swan events that led to what's been now really almost a 10-year decline in the commodity price. You had the bubble, if you will, in 2007, when the price of uranium hit over $130 a pound in the spot market. It was exacerbated by the 2008 financial crisis, which was obviously a global event. And then there was this rebound, almost like a dead cat bounce, if you will, in 2009 in 2011, but then Fukushima happened, and it was a terrible disaster. But what it did is created an opportunity in the uranium sector for companies and groups to go out there and acquire projects at attractive valuations, not just projects, but also put together geological teams that, because the industry was under pressure, was under siege, were available. We're out there and we're open to working with new groups. And, that's where I come back to Rick. I mean, Rick was really there from day one with us when we decided, okay, this is the sector, this is the commodity we feel we have the best opportunity in, that we can provide our investors, our shareholders, with the best opportunity in. And, I'll note that we weren't expecting the space to turn around immediately, and as we know, it certainly hasn't. But really, that was the silver lining, if you will, was that we believed there was going to be a number of years to build this platform, lay the foundation, acquire these projects that we were getting for really kind of pennies on the dollar, when in previous cycles they were trading at the companies they were in were trading at many multiples in terms of valuation to what we were able to acquire them at, and actually still multiples of what Skyharbour is trading at to this day. So we took that contrarian approach. We were diligent. We had a very selective criteria set for our acquisitions. And Rick and his team, Rick's a 40-year veteran in the Athabasca Basin. He was the exploration manager at Cameco for a number of years before starting and running his own company, JNR, which he built and sold to Denison Mines. Denison's our largest strategic shareholder, as you know, and their president, CEO, David Cates, is on our board, and we have a strategic partnership, a great working relationship with them and their team. But getting back to what I saw and what we saw with an opportunity in the uranium space, it was both the macro side of it. Obviously, Fukushima, we saw the price of the commodity declining. We saw, we eventually going to be supply cuts, which would ultimately help the price in the mid to long run. We're really starting to see that come to fruition now. And then on the demand side, the interesting thing is we know the demand side continues to grow. A lot of people aren't aware of this, but in 2016, more nuclear electricity came on the grid globally than any year in the last 30 years, right? We have 58 reactors under construction globally. We have hundreds more reactors that are ordered, planned, or proposed. But you don't really hear about this in our media, right? You don't hear about this in North America or even parts of Western Europe. This is the narrative in China, in India, and other parts of the developing world. There is serious air quality, air pollution problems in these parts of the world, and they need electricity, but they need clean, baseload CO2-free electricity, and that's nuclear. So we saw, this combination of supply, eventually, as we're seeing it now, coming offline because of low prices, but we also saw this growing demand going forward. And so it was a really kind of a unique set of circumstances from a macro standpoint that excited us initially. Like I said, again, we weren't expecting it to turn around right away, but as we've seen in the past with uranium cycles, if you look at it, the previous few cycles, and it's always interesting to study these, uranium does go through these longer drawn-out bear markets as we see, and the price basically gets so beat up, and a lot of times it's in previous cycles and in this cycle, you've had excess secondary supply that's hit the market, that's driven the price of the commodity down as much as it has. And just to give those numbers, you're trading at around $22, $23 spot price today. Well, the lowest cost producing mine in the world, which is in Kazakhstan, is barely break even at the current spot price. So most production out there is underwater. The average global all-in cost of production, current producing mines, is in the low 40s, and the price needed to incentivize new production to come online with the pipeline projects that are out there, most analysts are forecasting you need $60 to $70 uranium. That's a significant increase from where it's trading at currently. So a real interesting opportunity that's unfolding. that was part one. So part two, specifically for a jurisdiction to go and start building an asset base, and then ultimately going and advancing, value adding, exploring the projects as we're now doing. The Athabasca Basin to us, and Jim has worked with companies in the Athabasca Basin previously, so the team here knows the basin well, geological anomaly unto itself. And if you look, you look at the highest grade deposits in the Athabasca Basin, they're just simply spectacular. The two operating mines, they're MacArthur and Cigar, where they're mining at 15 to 20% U3O8. And for people that aren't familiar with uranium and uranium grades or global average grade, the Athabasca Basin is on an order of 10 to 20 times the average grade of global uranium deposits. You've had a real unique set of geological events and circumstances that have created this kind of high grade deposition, multiple mineralizing events over many years that have created these high grade deposits. And so, as they say, grade is king, right? And the Athabasca Basin hosts these incredibly rich uranium deposits. They're actually, on a per ton basis, some of the richest type of mineral deposits you can find of any mineral type, whether it be gold, diamond, silver. I mean, if you just take copper, for example, and if you look at the grade equivalent on a per ton basis, I always find this interesting, but 1% uranium is equivalent to about 13% copper. So if you think about that for a second, if you were to find, let's say, 10% uranium, U3O8, which is quite high grade, but they're mining those kinds of grades at MacArthur and Cigar, that would be over 130% copper. It's impossible. You can't even find a deposit that on a per ton basis has that kind of mineral wealth. So why is that important? One, it brings your cost down. Two, for us as an exploration company and as a group that is focused on going out there and exploring these projects, drilling these deposits that hopefully one day will become a mine, I like to use this term called return on drilling. So if you're spending, let's say, $40,000 or $50,000 drilling a hole into the ground and trying to prove up a resource, you want to get as much bang for your buck as you can. Well, to do that, you obviously need to hit mineralization. That's always, that can be the toughest part, obviously, of this game is that, especially the early days, going out there and finding that needle in the haystack, if you will. But once you have found it and you can start proving up a resource, and this is really what we're doing at our flagship, the More Uranium project, which is on the east side of the Athabasca Basin. Once you find it and you start proving up mineralization, each and every drill hole that you have high grade in can prove up a lot of pounds of uranium. Your return on drilling is quite high. The risk reward profile is quite attractive. So that was specifically why we chose the Athabasca Basin, not to mention it's in Saskatchewan, which is now ranked the #1 mining jurisdiction in the world by the Fraser Institute. The other thing that was really intriguing to us initially in 2013 was these new discoveries on the west side of the basin. Now, you're obviously familiar, and I'm sure a lot of your viewers and subscribers are quite familiar with Fission, with NextGen, even with Hathor, which was on the east side of the basin. Hathor was acquired by Rio Tinto a number of years back for, I believe, around $550, $600 million. So a notable acquisition of what was a junior exploration company by a much larger mining company. But what's happened in the last, I would say, 5 to 10 years in the Athabasca Basin is you have seen some new technologies, you've seen some new field and exploration techniques, and just new ways of thinking that have really helped the exploration process, have helped these companies find these new deposits, and have helped these companies delineate these new discoveries and deposits. And that's always something that was interesting to me. You look at Fission, for example, the low-flying radiometric surveys, the boulders that they found. You look at some of the directional drilling that NextGen's doing. And one of the things that really kind of has changed, especially in the last 10 or 15 years, is this notion that the best, highest grade deposits in the Athabasca Basin had to be at the unconformity. There's two types, really, call it, to summarize, two types of deposits you can find there at the unconformity or in the unconformity. That's in the overlying sedimentary rock or in the basement rock, right? And the basement rock is obviously below the Athabasca sandstone. It's been some of these new discoveries, in particular with fission and NextGen. You look at Denison's Griffin deposit, basement hosted. You look even at MacArthur, right? MacArthur, some of the highest grade zones in MacArthur are in the basement rocks. So looking into the basement rock, right? Looking for high grade uranium mineralization in, call it these feeder zones in the basement rock. Some of the best discoveries that have been made in the basement rock. And so, it's not just about going in and using some of these new techniques, geophysics, drilling techniques, but it's also, a kind of a bit of a shift in thinking in the basin that, there's multiple potential target types, not just an traditional unconformity hosted deposit. So, we looked at all of these factors, and really, I believe, obviously, to this day, still presents an incredible opportunity for value and wealth creation, both at the junior and exploration level, the development level, and the production, and actually producers out there. The Athabasca uranium as a commodity, obviously, I believe still has a lot of upside from here, but in particular in the Athabasca Basin, having these high grade deposits is really a big part of our story. Looking for these deposits, and as I say, the potential return on drilling, like a return on investment, if you will, finding these and delineating these resources, it's really quite unique. And again, I come from more of a commodity agnostic background. So, if you compare it to gold, copper, silver, some other metals, these high grade uranium deposits rank right up there in value, in potential value, if you find one and you delineate it.
Well, Jordan, finishing up in our last couple minutes here, there was just a couple weeks ago the World Nuclear Conference in Toronto, and a lot of interest since Kazakhstan has cut back production, which happened last year. That really helped to drive the price of uranium up. The other main factor being Japan restarting some of their reactors following the Fukushima disaster. So some rumors, though, came out of that conference in regards to Kazakhstan and their plans moving forward. Can you touch on what you heard?
I wasn't there, but I talked with a number of people that were at the conference, and there were some key takeaways that I heard of, as you just mentioned, with Kazakhstan. As we know, look, Kazakhstan's the largest producer of uranium globally. It's a very important part of the world for uranium production. It's relatively new, though, right? I mean, Kazakhstan really is just kind of in the last 10 years. Come to be as this the leading uranium producer in the world. They have some incredible deposits there. It's very low cost, lowest cost jurisdiction in the world. But the point, as I talked about earlier, is you have a spot price right now with the commodity that's been really beat up from secondary supply from Japan, from the Department of Energy in the U.S., from underfeeding. And so we now have a situation where the spot price is trading at a significant discount to the global cost of production. And you hear the experts talk about this, but I can't emphasize it enough. What you have in Kazakhstan is a situation where they sell a fair bit of their material on that spot market. There's a long-term contract market, which historically is where most of the volumes of material of uranium have been traded. The largest producers like the Chemicos and Arevas of the world, are set up to basically sell their production on these long-term contracts. The utilities companies, the purchasing managers for these utilities companies negotiate terms over 5, 10, 12-year contracts. And that's really where most of the uranium, the yellow cake, is traded. There is the spot market, but the spot market historically has been a relatively small part of the market. Now, Kazakhstan's come online in the last 10 years, and they do sell proportionately, right? Proportionately, a relatively larger amount compared to other large producers on the spot market. Well, as I just said, the spot market is a relatively small market. So that production coming on and that supply hitting the spot market has also had a negative impact on the price. So what I heard from the conference and what we're hearing is Kazakhstan is at $22, $23. As I said, it's still a very low price. Most of the mines there are not making money if they're selling at the spot price, and as all mines globally wouldn't be, as I mentioned earlier, the lowest cost producing mine being break even, all in costs around $22, $23 uranium. So the squeeze is being felt, right? Especially if you're having to sell material in the spot market. Now, what's interesting and what is potentially going to be happening with Kazakhstan, one, they're talking about a go public or some portion of Kazatomprom going public, which would be interesting, kind of, I guess, like what you're seeing in Saudi Arabia with oil. But the other real interesting point that hasn't really been talked about as much in the mainstream media or the mining mainstream media, if you will, is Kazakhstan looking at setting up a Swiss intermediary, a marketing intermediary, much like other larger producers have done, Western producers have done historically. And what this will allow them to do is time the sale or the sales of their uranium. They'll be able to control that more than just having to sell it into the spot market. Now, this, I think, could be very important going forward. This is how large producers globally have historically done it. When they want to sell their product and their supply, their production into the market, call it, you don't want to be selling a good chunk of that into the spot market. You want to have these long-term contracts at the fixed prices where you're going to be able to sell it over a 5-10 year period at a good price. So Kazakhstan is moving towards that, and I think that'll be very beneficial for the spot market going forward. So that's on the supply side. Now, just to kind of summarize on the supply side, sum up the supply side, right now, or as of 2016, you had 180 million pounds of annual demand. That's what was required last year. We have 160 million pounds of primary mine supply. You're already in a shortfall. Now, where is that 20 million pounds and some coming from? As I said, secondary supply. But at the current prices, you do not incentivize new mines to come online. You just simply do not have a price in the low 20s that will justify the big capex, the big spends up front to build a mine, bring it online, and operate it. I mean, that's just to get it online, but then you have your actual operating costs. And as I mentioned earlier, the average global all-in cost of production is in the low 40s. So even an operating mine, you're looking at it losing a lot of money at $22, $23 uranium. We've seen over 15% of primary mine supply cut in the last about 18 months or so. So you have seen production producers respond to these low prices. We hear that term, what's the cure for low prices? Well, it's low prices, and I think we're starting to see that. We will also, I believe, see further cuts when some of these existing long-term contracts expire. It's important to note that over the next 6 to 7 years, you have over 3/4 of the existing long-term contracts, so the contracts that most of the producers are selling their uranium to the utilities, the nuclear utilities companies, at most of those contracts expire in the next half a decade. And that's important. We're coming into what's called a new contracting cycle. This is very similar to what we saw in the early mid-2000s. We knew we were coming into a new contracting cycle where the utilities companies were going to have to lock up longer term supply. And you got to remember, the cost of a nuclear reactor, the fuel cost, the uranium to fuel that reactor, it's relatively negligible compared to, let's say, a natural gas or coal-fired power plant. The cost of a reactor, it's less than 5% is the fuel cost. What that means is that the purchasing managers for these nuclear utilities are much less price sensitive than they would be if they were having to buy natural gas or other fossil fuels, where it's a big chunk of the operating costs of the power plant. So we saw this kind of come, what that means come to fruition in the mid 2000s, when the price ran up from, in 2004, 2005, $20 a pound, kind of close to where it is today, and it ran up to over $130 a pound in the spot market in 2007. And a part of that had to do with the fact that there was this new contracting cycle. The utilities were coming back to the market. They all came back in a relatively short period of time, and they're not as price sensitive as other purchasing managers with other utilities companies. So it's this kind of confluence of different factors. The supply side, secondary supplies starting to wane. We're still working through. There still is secondary supply out there, but as the name implies, it's secondary in nature. It's not primary mine supply. Lack of new projects and mines coming online, so lack of new mine supply of any significance coming online over the next few years. And the demand side, as I said, the demand side is growing. We know in the next 4 to 5 years, there's 58 reactors under construction. A good chunk of those are actually coming online in the next 2 or 3 years. They're also, if you look at the new reactors coming online, especially in places like China, which accounts for about a third of those 58 reactors under construction today, these new Gen 3 reactors are much larger. So it's not just the number of new reactors coming online. You actually got to look at the type of reactor coming online. They're much safer, they're much larger. You think of it like this, it's like building a mine. You want to mine as much of the ore. You're going to sink billions of dollars, let's say, into a project, into the development of a project. You want to mine as much ore out of the ground as you can get. You want to generate as much revenue after having sunk all those costs into building it. Well, it's kind of a similar situation with a nuclear power plant. These are big, expensive projects. They produce electricity for many years. You want to produce as much electricity as you can from one power plant. So these new reactors, that's what they're really designed to do. They're safer, they're more effective, and these new reactors coming online will require a lot more uranium going forward.
Well, Jordan, on that note, thank you so much for sharing all of your knowledge on the nuclear space, and best of luck on continuing to move forward with Skyharbour. I appreciate you coming on the show, and very good to see you last week there in New York at the Mines and Money Show.
Always a pleasure, Colin. Looking forward to seeing you soon.
Think you understand the junior mining sector, and you think that the participants in the mining sector, junior mining sector, are good people and kind people, hit the bid.
How violent that term could be, it actually could be quite violent. It could be a rip your face off uranium rally.
And the world is always going to need raw materials. It's going to need copper and gold and nickel and so forth.
Totally destabilized. Hey, Troll, did you hear what's going on in Yemen?